Hi folks, I'm Hector Garcia. I'm a CPA and a professional tax preparer. I want to talk to you about the differences between itemizing deductions and taking the standard deduction. For some context here, in the year 2018, after the tax law changed, the standard deduction went up to $12,000 for single taxpayers and $24,000 for married filing jointly. That is an increase of almost double. As you can see, 2017 single standard deduction was $6,000, just over $6,000 for singles, and for married was just over $12,000. Now, for head of household, that means that you're a single and have at least one dependent. Those numbers now went to $18,000. Anyway, so what we're trying to achieve with this video is trying to determine whether or not it is worth it for us to itemize the deductions, which will be done using Schedule A from your personal tax return, or should we take a standard deduction? In other words, what we're trying to achieve is to understand on whether or not adding up all the numbers from the itemized deduction becomes a bigger number than standard deduction. The standard deduction is meant to have two goals. One is to simplify the tax preparation, in which you don't have to explain anything, you just take the standard deduction and that's it, or to help those folks that don't have the itemized deductions. Now, the typical things that we think about when itemizing deductions is, do we have a significant amount of medical and dental expenses? That would be the first question you want to ask yourself. Second, did you pay any local taxes? So a state or local income tax, or maybe property tax for your property. Those things would be deductible in the itemized deductions form. Did you pay any interest for your mortgage of your personal residence, or did you pay any investment interest of loans you took out against your investments through your broker? Did you have any gifts to charity, whether they're cash or goods that you gifted to charitable institutions? And did you have any casualty losses in a federally declared disaster area? So those five main components are what comprises the itemized deductions. Now let's dig in a little bit deeper. Medical and dental expenses. So any payments to doctors or medicine, not your insurance premiums, just the doctors and the medical expenses, are deductible. However, there is a 7.5% floor or minimum, which means that you take your total income, or your AGI, adjusted gross income, and you multiply it times 7.5%. For example, let's take $100,000. Let's say that your salary between your whole household is $100,000. 7.5% would be $7,500. Only the expenses above $7,500 would count. I don't have that many customers in which this actually applies. You would have to have a significant amount of out-of-pocket paid medical expenses for this to count. But if you had to pay for surgery out of pocket or something like that, you probably will fall into this category. So you may want to check against that 7.5% to see if it's even worth breaking that down. Now let's talk about taxes you paid. So if you paid any municipal, local, state income tax, for example, I live in Florida and we don't have any state or local income tax, but if you are in California or New York or Illinois or any of the states that have income or local tax, you may have multiple layers of taxation. You may have your federal IRS tax plus some local taxes. Those are deductible, as well as the property taxes for your main residence. So your local main residence only. If you have rental property, that property tax would go in a different form altogether. Now you add up all those numbers together and you're going to put them in this form. There is a cap of $10,000 for single and married filing jointly individuals on those itemized deductions for local taxes. So regardless of what you paid, the most you can take as a deduction for this form would be $10,000. Now, one really important caveat: if you're filing married filing separate, the cap is $5,000. So now let's talk about mortgage interest. So the tax law changed and there's a cap on the amount of mortgage indebtedness or your loan amount that would qualify for this. That number is $750,000. So most Americans should be okay because most people don't owe more than $750,000 in the personal mortgage. So only up to the first $750,000 worth of the mortgage you can deduct the interest for. So if you have a much bigger mortgage, you're going to have to do a special form, and that deduction is going to phase out as the number gets bigger and bigger. In other words, any interest you pay for your mortgage will be what you put in this page. Now, if you have an investment account that you have stocks or bonds or something like that, and you don't sell them, but you take a loan against them, any interest that you pay for that loan, that would go on this form on where it says investment interest. Now let's move on to charity. For the most part, when you're making cash payments to charity, that's pretty simple. Any cash payments you make, you put them in this form. If it's more than $250,000, if it's more than $250, you have to itemize and list all those charities that you paid to, and the dollar amounts. If you're paying with goods, in other words, if you're going down to Salvation Army or Goodwill and dropping off clothes or shoes or whatever, you're going to have to do a formal valuation of those goods to figure out how much of that you can get a credit for. Now, also, there's a 50% of your income limit for the charity. So you cannot take a deduction for any charity given that it's above 50% of your income. If you gift more than 50%, that will not be a deduction you can take this year. And finally, casualty and theft losses. That means that if you are in a zone that's been declared a federal disaster area because of a fire, a hurricane, a tornado, whatever, only if it's been declared a federal disaster area, any losses you take that the insurance company did not reimburse you for would be deductible on this page. So at the end of the day, you add up all those numbers, the medical expenses with the 7.5% floor, so only the amount above that, all your local taxes, including your property taxes up to $10,000, the interest you paid in your mortgage, as long as it doesn't go above the $750,000 mortgage indebtedness amount, all the gifts to charity limited to that 50%, and the casualty losses. You add up all those numbers, and if that number in the bottom, it's actually higher than the standard deduction, then it's worth it for you to take itemized deductions. Now that answers that question. However, beyond itemized deductions or standard deduction, there's other types of deductions that you can take that are worth looking into. One of them is what they call adjustments to income. So you can reduce from your gross income any losses that you take on real estate rental activity, on a business. Obviously, a business loss would be something you would deduct from your income. A capital loss, so if you took any losses on the stock market for something that you bought and sold at a loss, you can take a loss. There's a limit of $1,500 per year for single and $3,000 for married, but you can take a loss with that. Certainly can do that. If you're self-employed and you paid for your own health insurance out of pocket, and you have to look into the rules of exactly how that works, you can take a deduction on that. If you paid student loans up to $2,500 worth of interest per year, you can take a deduction or an adjustment of income against that. If you made contributions to a self-directed retirement account like an IRA or a SEP, that could also be reduced from your taxable income. There's another deduction called Qualified Business Income Deduction. Now, this one's a really complex one because there are all sorts of rules around it. But if you have your own business and you have income through that business and you make $315,000 as a married filing jointly or $157,000 as a single, you can actually reduce 20% of that income as part of your overall taxable income. So for example, let's say that I have $100,000 of income altogether. $50,000 is my salary from another job and $50,000 comes from income from a business. I can actually reduce that $50,000 down by $10,000, 20% of that to my taxable income, right? So that's actually there, new for 2018. If you make more than $315,000 as married, filing jointly, or $157,000, there's all sorts of rules and limits based on the type of business that you have. If you have an S corp, you may have to have special a certain dollar amount in payroll. There's all sorts of limitations around it, but for most taxpayers, they're going to get that straight 20% deduction from their business income. And finally, we'll quickly talk about credits. You can take a credit for every dependent that you have that is a child. There's a special credit for that. Also, if you pay for their daycare expenses or after school expenses activities, that allows you to work while they're in that special school or in that daycare, you can take a credit for that. It's limited to $600 per kid. And if you have an older dependent or a dependent of any age really that you are taking care of and you have to pay to take care of that person because they're sick or incapacitated, whatever, you can take the same similar type of credit with those folks as well. The other credits worth talking about is a foreign tax credit. That means that you have income from foreign sources, which you are going to pay taxes in the U.S. for, but you get a credit on sometimes the whole thing or a piece of the taxes you paid overseas. There's also the net premium tax credit. These are for folks that have insurance through the Affordable Care Act, and at the end of the year, it will calculate whether or not you got too much subsidy or too little subsidy from the government with the Affordable Care Credit Act, known as Obamacare. And if you pay too much, they're going to give you some money back. If you pay too little, they're going to charge you that difference in the tax return, right? So it's actually a credit and a tax potentially. And lastly, the earned income credit. This is really for low earners that have some income and have dependents. And it's basically a tax credit that a lot of folks have in order just to help them with their income overall. That's really for folks that are beyond a certain percentage of the national poverty rate. Anyway, so this should be a really, really good comprehensive video about deductions. If you're using tax software like TurboTax, that sort of thing, will probably guide you through this process. If you're using a tax professional, that person should probably also guide you to the process. But I think it's important for you to have that sort of checklist of all those things that are potential deductions for you and proactively bring to your accountant upfront so you have all that stuff handy. I have an Excel spreadsheet that I give to some of my customers when they ask for that information that has a checklist of all the things, just so you can use it as a checklist or add some notes to that. And you can click on the description below somewhere to get to that. I'll have a whole bunch of videos all about tax and tax deductions, so check the description for that as well. And anyway, if you like this video, please hit like, subscribe to the channel, add some comments below in terms of what else you would like to see. And if you need a tax professional, there's my email and my contact information in the description. Call my office and let's schedule to work together. Thank you.